Welcome to Uncovering Trusts, a podcast by Edison Group. I'm your host, Will Manuel, and today I'm joined by Miloš Pabst, Director of Investment Company Content at Edison, who will talk about Franklin Global Trust, whose ticker is FRGT. Miloš, thanks for joining us today.
Thanks, Will. I'm looking forward to revisiting this trust.
Great. So a good place to start is to discuss what's changed over the last year.
Sure. First thing is the company name. The Franklin Global Trust was the Martin Carey Global Portfolio Trust until April 2025. To provide some background, Franklin Templeton Investments took over Martin Carey's parent, Black Mason, in July 2020, but the Martin Carey brand was only retired this year. The trust was launched in March 1999 and since October 2018 has been managed by Zairi Dosmani, who was head of Martin Carey's global long-term unconstrained investment team. On the 12th of July 2025, it was combined with the Franklin Equity Group, a much larger team of around 65 investment professionals, and its CIO, Jonathan Curtis, became co-manager of Franklin Global Trust. Franklin Equity Group is a large US asset manager. At the end of 2024, it had more than $130 billion of assets under management.
What is the trust's objective and how do the managers seek to achieve this?
Yes, so the trust aims to achieve long-term returns in excess of the total return from the MSCI All-Country World Index. While the enlarged investment team brings a more extensive research capability, the fundamental strategy has been maintained based around the philosophy that equity markets undervalue sustainable growth companies that can deliver long-term value for shareholders. Essentially, the managers are looking for high-quality growth opportunities at sensible prices. Franklin Equity Group is based in Silicon Valley, which, of course, is a major center of global innovation, which I believe should enhance the team's ability to seek out these types of companies, particularly in rapidly evolving sectors such as technology and healthcare.
Okay, so let's spend a bit more time and more detail about the investment process.
Okay. In practice, the managers run a high conviction portfolio of 25 to 40 quality global growth companies with superior share price appreciation potential based on projected return on invested capital, balance sheet strength, and sustainable business models. They invest with a 5 to 10 year investment horizon based around three steps. The first step is idea generation. The total universe of around 2,800 listed global stocks is screened down to an investable universe of around 500 companies, and then a research pipeline of 90 plus names is prioritized to identify companies with a combination of quality, sustainable growth, and an attractive valuation. The second step is fundamental analysis, which is based on 8 key criteria. Industry analysis, a company's growth drivers, returns, financial strength, accounting, corporate ethos, ESG profile, and valuation. A proprietary research template is compiled for companies reviewed, and each is given a conviction rating between 1, which is strong buy, and 5, which is sell. And then finally, portfolio construction. Each position is weighted appropriately, aiming to ensure a meaningful contribution to returns while taking risk into account. I would note that the managers strongly believe that including ESG analysis in investment decisions delivers improved returns for the trust shareholders, and it is integrated throughout the proprietary investment process. More than 50 underlying criteria are assessed to capture the complexity of ESG risks facing a company's long-term growth outlook and sustainability.
Okay, so taking the philosophy and process into account, what does the resulting portfolio offer investors?
The trust is a straightforward equity portfolio with no unlisted businesses or derivatives. It is relatively concentrated with around 30 holdings. Although these are diversified by geography and sector, there are 3 out of 11 areas of the market with a 0 weighting. There are no energy, real estate, or utility stocks, as these companies do not meet the manager's long-term growth criteria. Invested companies are likely to be beneficiaries of one of 3 megatrend growth themes: the future of technology, resource scarcity, and demographic change. The largest sector weightings are technology, which makes up around a third of the portfolio, followed by healthcare, which makes up around a further quarter. Now, in terms of significant active positioning versus the benchmark, there are approximately 15 percentage point and 8 percentage point overweight positions in healthcare and technology respectively, and an 8 percentage point underweight in financial stocks. Healthcare, as we know, is an unloved sector these days, which the managers believe has the potential to perform relatively better. Despite the sector currently being under pressure from political risks, it has favorable demand and earnings growth characteristics and also has valuation support. Within the trust's healthcare holdings are different categories. Stable growth such as AstraZeneca, defensive growth in animal health names, IDEX and Zoetis, and R&D-driven growth, including Mettler Toledo.
Okay, so turning to the geographic exposure, can you give us some details on that?
Well, unsurprisingly, given its dominance in global indices, the trust's largest country allocation is the US at around 60%, which is around 5 percentage points less than the index weighting. The most notable difference is Europe, where the trust is about 20 percentage points overweight versus the index, as the region is considered considerably less expensive than the US. The trust also has around a 12 percentage points underweight Asian exposure.
Okay, and can you highlight some of the largest portfolio positions?
Yes, of course. The top 10 holdings make up around half of the portfolio. Within this are some well-known US large-cap technology companies, including Microsoft and NVIDIA, and consumer names such as French personal care company L'Oréal and Italian luxury sports car manufacturer Ferrari. There are also some businesses that may be less familiar, such as ResMed, which is a US-based but Australia-funded manufacturer of medical devices and software applications to diagnose, treat, and manage respiratory disorders, and Viva Systems, which provides cloud-based software for the life sciences industry.
And given the trust's growth bias, I guess discussion about performance is in order.
Indeed. As you may have suspected, in recent years, the trust's performance has been disappointing, a large part of which is down to owning growth stocks that derated in a rising interest rate environment. Also, the trust's relative performance was due to having insufficient exposure to the Magnificent Seven large cap technology stocks, which investors seem to, view as the only game in town. However, over the long term, the in-depth fundamental stock selection approach has been a winning strategy. The managers are optimistic that with the broader stock market leadership and the return to focusing on company fundamentals rather than share price momentum, the trust can return to form. Nevertheless, the managers have continued to make improvements to the investment process. Given disappointing results in 2024, there is now more efficient screening to provide an early indication of earnings and share price trends. There is an increased focus on earnings risk assessment, both in terms of short and long-term risks, as well. Avoiding earnings misses can obviously greatly improve performance. Also, there is a heightened emphasis on key thesis indicators, which provide a timely identification of operational deviations away from the core investment thesis, along with a sharpened sell discipline, which involves a faster and lower tolerance review of stocks on a so-called hospital list.
Okay. And before we finish today, are there any other points for our listeners to consider?
Just a couple. Firstly, dividends. Income is not a major feature of this trust, as there has been a 4.20 pence per share annual distribution for the last 9 financial years. There are considerable distributable reserves of around 60 times the annual dividend payment, which can be drawn on when required. Secondly, since 2013, the trust's board has employed a zero discount policy, aiming to ensure that in normal market conditions, shares trade close to NAV. And this has been an effective program, and shares are bought back on most trading days.
Okay, well, that about wraps this session up. Thanks for the catch-up on this high-quality global equity fund. It will certainly be interesting to follow the portfolio in light of the broader investment team and enhancements being made on the performance front. You've been listening to Uncovering Trusts, a podcast by Edison Group. If you want to find out more about FRGT and other investment companies we cover, please visit www.edisongroup.com.